Good afternoon, everybody. Welcome to I'm going to call it the Southern California Exit Planning Institute virtual series. Every year we do a business owner event. Since we are not able to do it this year, we decided let's do a virtual series for business owners. We started it back in May, and we did 3 sessions in May and June. And now this is the second one in our second part of our 4-part virtual series. Today we're going to be talking about tax planning, estate planning, and charitable planning issues, what you should be thinking about for your businesses. And we have 2 great, wonderful speakers for that. But before we do that, I just want to let everybody know, my name is Melissa Silverman, and I am the president of the Greater Los Angeles Exit Planning Institute chapter. And we are joined with one of my partners, Joe Strazzeri. Joe, you want to introduce yourself?
Hi, I'm Joe Strazzeri. I'm sitting here next to Shelley Lightfoot, who's the executive director of the Southern California Institute and one of our partners at the Founders Group.
Hi.
Hi,
and Joe is also the president of the 2 other chapters you see there.
I'm lucky enough to have taken over the Orange County and the San Diego chapters, both who were founding at the time of the Exit Planning Institute, after watching my partner Melissa do so well with the Los Angeles chapter. Both of us have spawned off a couple of other chapters around us that have done really well. Melissa, what's the name of the chapter just north of you?
It's the Conejo Valley Exit Planning Institute chapter.
Conejo
So
Valley.
anybody interested in that chapter, let us know.
And then there's a chapter starting up in Riverside run by Carrie Voorhees, one of our friends in Riverside, California as well. So Southern California has been a good place for the Exit Planning Institute and its expansion. Great place for you to find other professionals that do what you do or the things you might need. Let's see here. Oh, good. I've got a slide out.
So this is the 4 companies that Joe and Melissa and myself represent. I'll let you go ahead.
Sure. So the Southern California Institute puts on about 250 programs like this a year. Similar to the Exit Planning Institute, it's about education. And for the Southern California Institute, it's legal, financial, tax, and counseling. Technical. Avenue M is a valuation firm run by Melissa Silverman. Strazzeri Mancini is a law firm that helps successful families and business owners get to the heart of highly relevant matters, working with integrated tax and estate planning, business succession, and family business conflict. And then Founders Group, Melissa, Shelley, myself, Steve Mancini, and Jeffrey Cates own, that deals with, I've got a business, I'm at the decision point of, do I keep and grow or do I transition to my family, to my employees, or an outside third party, or in whole or in part. We often put the slide out first to let you know this is our bent as presenters. Always know when you're listening to presenters what their flavor might be, on what they lean more on, include more of, or include less of. So you now understand our backgrounds more. Shelley, you're up. Melissa.
Melissa's going to do this, yeah.
So today we're going to be talking about tax and estate planning for the sale of a business. This is our second in our virtual series. It's a 4-part series. And the next one will be held on October 27th, and it's going to be focusing on business operations, tax considerations, and end-of-year tax planning. And our last one will be held on November 17th. It's going to be focused on transition or succession planning changes in the current market. Both of these sessions will be held on, one will be held on Tuesday, October 27th from 2:30 to 3:30 p.m. And then again on Tuesday, November 17th from 2:30 to 3:30 p.m. So we hope you'll join us for these 2 sessions as well, where we're going to have new experts who will talk on these subjects. So with that,
you can see on the slide on the flyer, if you look closely, you can see there's a few other topics under each one that'll get covered as well. We've just listed here on the slide the primary ones. Sorry, it's going backwards on me. So we've already introduced Joe. Melissa, do you want to introduce George real quick?
Yeah, so George Dolgerian, and I never say this right. He is with, did I get it right? No, I'm sorry, George. He is a senior, a senior development officer with the California Community Foundation. He works with professional advisors and donors to facilitate gifts of complex assets. So if you're looking to make a charitable donation, a donor advised fund, George is the guy who can help you with that. Before joining the California Community Foundation, George practiced as a senior tax consultant at Deloitte Tax. He was advising business owners and high net worth individuals and families on a variety of tax, federal, state, and local tax matters. He also earned his Bachelor of Arts degree from the University of California, LA, UCLA, and he got his Juris Doctorate, well, his JD and Master of Law in Taxation with distinctions from Loyola Law School. So with that, I want to turn it over to Joe and George. But before I turn it over to them, no one really did a proper introduction of Joe. So let me just do a proper introduction of Joe. I'm not going to do it the way he normally does it, but I will say that Joe started off and he was a general contractor by trade. He hammered nails to put himself, well, he hammered nails to put himself through law school. And then he developed a very successful legal practice doing trust and estates and tax work, working with who he loves to work with, which is business owners and entrepreneurs and families, helping them to figure out the messes that they have and get to the relevant matters so that he can really help them provide solutions that will help their families and their businesses. And so with that, I'm going to turn it over. And in addition to that, he has all these other companies as well. So Joe and George, take it away. It's all yours.
Thank you.
May I just say really quick, Joe, also, we didn't mention, if you have questions, please feel free to type them in the chat function. We'll be monitoring. We have Kathleen Tepley here with us as well. A lot of you know Kathleen. She'll be helping to monitor, as will myself and Melissa. So if you have questions, please go for it, and we will interrupt at the appropriate time to get those answered. So Joe's got some fairly intense topics to cover here in the next half an hour. So Joe, go.
I think you won't be less than that because George has about 15 minutes as well.
Yeah.
So together, thank you, George, for letting us do this. So can you go back one slide, just so I can say this?
Thanks, Joe and Melissa.
So tax and estate planning for the sale of business. We're going to cover a couple of topics today. One is tax and estate planning for the sale. One is asset protection. Then 10 ways out of highly appreciated property. And then charitable planning are 4 major topics. By no means during this time could we make an expert on all these things. Yes, we can talk about them as an overview. Yes, we can list a lot of them. And we can also give you resources to that. The primary group of people on the phone today are business owners and entrepreneurs. Those people who own their own business. And some of the people on the phone today are the advisors that help them, who in some cases own their own business as well. Cool. So this is a list. I'm sure you can see there's some acronyms. Let's start at the top, NINGs and DINGs. The ability to have in Nevada for a NING, in Delaware for a DING, or in Wyoming for a WING. The ability to have a trust that owns an asset that is not sourced income in your own state, so it's passive income, and where someone else is in charge of it, and you are only but one of the permitted beneficiaries. So right now in California, I have clients that are very frustrated. They've said, Joe, we went from a 9 and change rate to a 13 and change rate. Now we're going to a 16.5% rate. For the money that I earn in California, those we're now increasing such that it's close to a 70-80% jump from the original 9% to the 16.5% that we're now looking at. In addition to that, we have ballots out right now. We're about to vote for the possibility that if you own more than $3 million gross, or more than $3 million gross of commercial property or industrial property or rental properties, like my apartment complex or multiple homes, more than $3 million gross of that, my tax basis on it is going to go up to fair market value. But Joe, I've owned it for 30 years. I'm going to go from $6,000 to $40,000 or $30,000 of taxes a year. That jump up is going to be a lot. Am I going to have to increase my rents, or do I not get as much? In addition to that, we have something on our ballot now that voted in November, where they're going to say we're going to give rent control possibilities for residential units. Rent control for residential units. They're over 15 years old, so not new ones, but old ones. To the municipalities, to counties and cities. So the ability now, I might have a much more large tax to have to pay, and my rent's going to be capped or can be capped. That plus the increased amount of income tax, should I be looking at doing something different? Should I leave California, sell my assets here and go buy in Wyoming, Nevada, et cetera? There's also the possibility that I can move some of my assets to a trust that's owned, those assets are owned by a trust outside the state. Of course, this building that I'm in, one of my friends, Jeff, is on the phone. We pay rent for that. That's California source income. But if it's not California source income, it's my investment portfolio or the income from my Hawaii property or my Iowa farm, why pay California tax on it? Even more so, if I have three groups of assets, the amount of assets I'm going to use, the amount of assets that my wife and I might need, and the third group of assets that we're merely stewarding for my kids, why would I subject my daughter, Maddie, that bucket that's for her now to California tax, and why would I subject her to California tax long term? In addition, if I was going to sell one of my businesses, and it was passive, a C Corp, would I want to pay California tax on the whole thing? 19098 overview, the ability to say if I have an investment portfolio that includes a lot of real estate, how should I be taxed as a C Corp or S Corp? I get asked all the time, Joe, give me the rule of thumb, what should I be? My answer is it's going to be dependent on each one of your own circumstances. And what might be right for you this year might be something different next year. It's a matter of sitting down and visiting with your CPA. Like one of the clients that we were lucky enough to have a sale, two of them this year, qualified small business stock, 1202. The ability to exclude $10 million of your sale, $10 million of your sale, if you have the stock during a certain amount of time and it meets through some criteria. If you'd like to know what that criteria is, simply email back over to us. I'll send you the sheet that I use to analyze it to exclude $10 million from the sale of your business. As well, if I wanted to, I could sell my business.
I think their Wi-Fi went down because Taz is gone. So let's just give them a minute, everyone. Okay, they're coming back, guys. Thank you for your patience.
I think I'm here.
We're back.
Yay.
All right. Sorry, what
Can you see
happened?
it? Can you see my slides? Yes or no?
No.
No.
No. So I can let Shelly reshare. Can you see me now, Melissa?
We good?
Yes.
And the slides. Cool.
And we can hear you.
I
Yay.
love that even more. So past charitable trust, which we'll talk about at the end with George, private foundations supporting organizations and donor advised funds. Would it be interesting if my business could be partially owned this way, and when the sale happened, we didn't pay the capital gains tax and the charity got this money? I could do it with a charity, or I could do it with something where I control that money that goes to the charity over time. Private foundations are the most sophisticated of those, require the most supervision by the Attorney General. Supporting organizations are the same thing, but you just say, we're going to support one charity, so that charity looks over my shoulder rather than the AG's office. And donor advised funds are run by a larger trustee that I can then direct.
Which George is going to talk
Which
about.
George is going to cover a lot. Deferred sales trust, or what are called intermediated installment sales, or intermediate installment sale trusts. Deferred sales trust is a term used by the estate planning team, but it's in the code as an intermediate installment sale trust. The ability, like we used to have private annuities, but not, because there's a third party trustee, the ability for me to sell my business or my asset to that trust for a note. It then sells the next day or a month later to a third party. That money comes in. It doesn't have a capital gains tax, but I pay the capital gains tax as I receive over time. Opportunity zones, as many of you heard, with any asset that's a capital gain, which could be even in your home over your $250,000 per person exemption, 500 together. If you have it over that, if you have a capital gain, you 1030 exchange a bunch, you still have some gain left. You could take the basis out and just reinvest the gain. You'll get a 10 or 15% deduction 1 year on how much tax you would pay. You leave it in play until 2026, and you're able to use the money you otherwise would have paid in taxes from now till then to reduce your tax. Monetized installment sales, very close to an intermediate installment sale, with the one exception that for the note, quite often months after you get the note, you've got an installment note due back to you over time that gets monetized or sold off, where you end up with somewhere around 93% of your original sale, and you owe the tax 30 years later. Captive insurance companies that are in place for businesses that may need to be unwound. Life insurance is a retirement plan. As many business owners on this call know, retirement accounts for affluent individuals is just a shifting of time you pay, but not a reduction in the tax. So I'm in the highest tax bracket now. I put money away in some sort of retirement account, some sort of defined plan, etc. And I'm going to take the money out sometime later. When I take the money out, I pay the same highest tax bracket I do now. Not a great plan for the highest earners, but for somebody who'll be in a lower bracket later, not a bad answer. Now that we no longer get stretch IRAs, even more of a conversation. So could I instead drop that money, pay the tax, drop the money into a Roth IRA? Yes. Could I also do that in a life insurance policy and get the same kind of effect, but have more flexibility when I take it and a bigger pop if I died early? Yes. Same thing with split dollar C Corp life or C Corp long-term care. It might make more sense now that our C Corp tax rates are lower to pay the taxes at the C Corp rate, have the C Corporation loan my life insurance trust money in order to buy a policy. That policy, when it pops, is in my life or my family's life, and we only owe back the premiums plus a little interest. So it might be a great way not to distribute the money out of the C Corp, but have a split dollar life policy or long-term care.
So Joe, you covered a lot of topics.
God, yes. Okay, you told me I had this much time.
I know, right? Well, I think my biggest question would be, how do you know? It's not always appropriate for every client.
God, no.
Right? So sometimes it's one of these things. Is it sometimes a combination of these things for a particular client?
Sure. So we always want to say from the Institute, we like I said, we do 250 programs teaching this kind of stuff a year through many instructors, not just us. In the early days, it was Joe and Steve.
Yeah.
But within this, we would teach often, be very careful as you're a business owner, be very careful for an advisor coming saying, let's solve the whole problem with this one tool. The whole problem with the one tool. Like economics, you don't move one lever a lot, you move many levers a little bit. So it's a combination of these or other things, which we'll have a slide on in a minute. It's a combination of things that tend to solve for each client's unique circumstance. Do they need access to cash flow? Are they looking to take care of other family members? Are they looking to take care of charity?
What's their timeline?
What's their timeline? Does charity only start at home? Is this the biggest part of their estate? Is it the smaller part? There are many factors to consider when you're talking about reducing that gain. So cool. So that being said, succession and capital gains. Succession and wealth transfer. Some of these are going to overlap. Most of our clients that had estate plans put in place 10, 20 years ago did things like charitable trusts, partnerships, LLCs, etc., to reduce an estate tax. Today, you can pass, as a couple, a little over $23 million of your estate without paying estate tax. If it goes back to the number it was in 2026, it'll be $5 million indexed for inflation, roughly $13.5 million a couple will be able to have. So if your estate is less than $13 million, a lot of the complexity we put in is no longer needed. So unwinding part of that makes sense. For those whose families have assets above 13 or above $23 million, there might be some unwinding because you can fix it with smaller strategies. B trusts. B trusts were very important. The loving trust revolution or the living trust revolution that everybody heard about. Get your revocable trust, avoid probate, take care of your surviving spouse. Well, we changed the rules a bit. We changed the rules a bit in that before, if I died, my portion, my coupon that could pass on to my family without paying a tax had to be used or lose the day I died. So if Shelley and I were married, I could either give it to her or give it to them the day I die. But if I wanted her to keep her coupon on me mine, I would end up putting mine in a B trust. She would have the A trust, the old AB trust, for the person above the ground and below the ground. That would protect against creditors, predators, bloodline, and estate taxes. Well, now, because of a portability rule, if Shelley doesn't remarry, I die, she can have my coupon without a B trust. So all of the handcuffs that I put her under, she doesn't have to have anymore. So many people who are both living spouses and they did an AB trust or an ABC trust may not want that B trust anymore because they can take the handcuffs off of Shelley.
Now, can you change that after they die?
It was very hard after they die, except for the terms of the trust.
Right.
And maybe we would want to decant it into Wyoming or Nevada to be able to change. Typically it can by court order or by decanting somewhere else, but some cases why
Much
would you?
easier before you die.
And the reason we want to do that is because whatever's in a B trust doesn't get a step up when the second spouse dies. Now in my case, my wife is 10 years younger than I am. This morning I had a really wonderful breakfast and she went hiking on Torrey Pine Hill overlooking the ocean. She's much healthier than I am. She's 10 years younger than I am, and she's a lady, so she gets 7 years on me. So the great likelihood is when I die, things get a step up, but if it was in the B trust, she'll die 20 plus years later, and she won't get a step up to avoid a capital gains tax. So I'd want it in a C trust, not the B. Estate freezes, for those people who have a high basis asset and they know they're going to die soon, they might want to freeze the value of estate to move it to the next generation. Under 10 business exit options, I have a little list here, which I can get to you guys. There are internal options and external options. It's more than just selling to a third party. Maybe it's selling to a family member. Maybe it's to management. Maybe there's an ESOP. Maybe do nothing and see how it goes. Keep and growing the business through enhancement initiatives. Or external, do we sell it to a third party? Do we refinance or recapitalize to get some working capital? If I'm big enough, can I go to an IPO? And in one of my clients' cases this year, we got more money out of the business by liquidating it because the pieces were worth more than the whole. We had some strategic buyers that wanted pieces, but not the rest. And the client actually kept a piece to give to the kids and got double the money that they would have. We talked about opportunity zones, a SLAT, a spousal lifetime access trust. Is it possible, if I'm worried about the estate taxes going from 23 million exclusion down to 13 and change, could I capture and say if it's going to go down in 2026, how do I give it now but still maybe have access? Again, if Shelley was married to me, which she never would, because she knows me too well. If we were married, could I gift to my wife? Could I give to my wife $11.75 million? And if I get it wrapped up, like Melissa gave me some discounts because they were LLC units about some properties, could I shift $15 million into her life for the benefit of my kids? Let her be the trustee. And if I died, it was in that estate. She could buy life insurance with it or not if she wanted to. She'd have access during her life, so I can get it through the back door, possibly. And as long as she's not the trustee the day she dies, it's not includable in her estate. So she could resign later when she wasn't concerned about needing access. So for our clients that say, I might want to lock in the larger amount, there's a way to lock it in and still get access, I might do that with a Nevada or Wyoming or Delaware trust combination because of the asset protection and the ability to access. Now, mind you, Shelley did not complain about having access to all that money.
Nor would she.
No, non-resident aliens, of course, if you're somebody who has a life insurance policy or annuity that was placed over 7 years ago, have them reviewed, because more than likely you could replace that policy today by paying less premium for the same amount or the same premium for a far greater death benefit. People often talk about premium financing for our clients that are land rich and cash poor. Land rich and cash poor. One of the problems with premium financing is that they refix the interest rate after so many years, and there's a possibility of a callable loan if the real estate value drops, if that's the security. Monolith is another form of that, where that's no longer the case. Actually sell it off for a bond. So you get premium financing without the fluctuation of interest rate or the fluctuation of security for real estate. And one of the last strategies that still get used, family generational split dollar. It involves life insurance. If I borrowed $1 million from my mom and I signed a note, that note would have to be payable back to her within her life expectancy. Anything past that isn't allowed, or won't be when she passes. But if I buy life insurance with it, that's the one exclusion. So I can form a life insurance trust for the benefit of my wife and kids, borrow the money from my mom, and say that I will pay her back after I die. That means when she dies, there's a note not payable for another 40 years. So it gets a greater discount. So there's ways in which still to make sure that we reduce the estate tax or the wealth transfer tax. If you're concerned that your assets are above 13 million, and you know the number's going back in 2026, or if the number's above 26 million.
And I'll remind you, if you have questions, please feel free to go ahead and type them in the chat function and we'll address them as soon as we can. Thank you.
This is a list. Thanks, Shelley. We often get asked, Joe, can you give me a list of most commonly used strategies in your practice for successful families and business owners? So we divided them up by 8 goals. 2, 4, 6, 8 goals. And in those 8 goals that you'll see, like the one up top, maintain control over your personal affairs, there are a list of strategies that are financial, legal, or tax, or a combination, that are the most common ones used in our practice. This represents maybe half of all the different types of things that we do. But if you're a successful business owner or family, these are the kind of things that you've been talking with your CPAs, attorneys, and financial advisors about. If you'd like access to this, if you send an email off to us, Melissa, Shelley, myself, we'll be able to give you a link to a part of a site that has these on them so you don't have to quickly write them down. Plus, they're also available in the slide itself.
Yeah, well, somebody asked if we would be able to share the slides, and you will get an email after the fact with the how to access the recording and the slides of this.
So again, there are a lot of acronyms. This is no more, no less, taking and organizing the strategies we use, legal, financial, and tax, and organizing them by goal for a family. Now, you're going to notice that some of them are repeated, because something that reduces income taxes can also offer credit protection. Something that manages the value of the family business can also be used to assure a lifestyle. So as Shelley said, it's not about which one of these, it's about which combination of these to use. And if you're considering the sale of a business, remember, you're dealing with capital gains, ordinary income, and eventual estate tax, asset protection, and lifestyle as you're trying to balance those out.
Speaking of asset protection.
Speaking of asset protection, think of asset protection like a continuum. I can homestead my home. It's a simple piece of paper that I can file with the county. We have exemption planning. We have joint ownership. We can gift to our kids or gift to a trust. You have an LLC or a corp. You have insurance for fire. You have insurance on your automobile. You might even have some protections for your own business. So you're somewhere on this continuum already. How far up are you going to go?
Most people don't really think of insurance as asset protection necessarily. It's something you have to have, right?
Well, you know, I'm allowed to drive a car without it. I just have to pay cash for the car,
Right. Well,
right?
if you want
I'm
to take
supposed to in the
take
state of
that risk, I
California,
guess. Yeah.
but if I own the car, I do. What am I doing? What's the likelihood my house is going to burn? I have paid for homeowners insurance, including fire insurance, for 40 years.
Right.
My house, thank God, has never burned down. But I have a friend in Northern California in the wine country, one of my clients that lost their house yesterday.
Oh.
So it's a possibility, and the risk is too great that I want to take on. I do have other homeowners insurance. I've never had any jewelry stolen, but I did get a bunch of bags stolen off the airplane.
Oh.
And there were 2 expensive watches in it. The insurance company paid me for it.
Nice.
So it was a risk against the liability. It's a risk against the liability that might be out there, which includes if my wife got in an accident today, God forbid, and a surgeon lost his hand, how much that suit would be greater than my insurance. So maybe I have some more other than that. So asset protection is a continuum. We used to have rules called fraudulent conveyance laws in California. We still have case law on that, but now they're called voidable transactions. So if I transfer something to somebody else for less than fair market value, they can void that transaction later, suck it back out, and the person that bought it from me for less gets stuck. Now, truthfully, if I then took an asset, moved it to another jurisdiction, country, or state who doesn't honor that, then the voidable transaction law is still valid in California, won't be valid for the asset because the asset's gone. But that's something to talk about. Asset protection is not a one-time event. It's a plan and a continuum, and best to do long before you need it.
And when you say continuum, you mean the most basic at the bottom and
Moving
the
our way
most
up.
complicated at the top. And what about them that are offshore things? Are those legal?
Yeah, then there are offshore things. Sure. We've made domestic trusts, domestic either third party or not trusts, like the ones in Nevada, Delaware, and Wyoming, a very good option for those who'd like to shift some of their assets. I have some of my assets in my trust, third-party trust created by Ballot in another state, first by me in another state, and both of them have provisions that they can move offshore if they needed to. Do I expect that we'll ever need to do that? No.
Hopefully not.
But I live in a world where I watch litigation all the time.
Yeah.
So I'm probably more afraid than the other one. And I worked really hard to get the stuff. The idea is somebody else taking it away bothers me.
And you're kind of controlling a little bit.
Are you telling me I control freak? So 10 ways out of highly appreciated property. And I believe after that, we're up to charitable trust, George. So you're going to be up any second.
You're going to cover this in a second?
Oh, no. If I have a stock portfolio that I bought into for, let's say, $1,000, and today it's worth $10,000, I have a $9,000 gain. How can I sell that and not pay that gain or pay it later? If I have a house that I bought originally for $248,000, and I've kept it and I now lease it out, and it's worth $1 million, there is a $752,000 gain. If I sold it, I would owe in the state of California and the federal a combined tax rate that's over 1/3 of that money, of that gain. That hurts. Reinvesting it, I won't get as much income. So what can I do? I can do a tenant in common. I can sell my property, do a 1031 exchange for another property, or I can do a 1031 exchange into an investment with other people in a tenant in common. That's the backbone behind Delaware statutory trusts, so I don't have to worry about finding the property. And then I get my income off of that. One day if it sells, I owe a capital gain, or if I die with it there, it gets a step up. In my case, my wife and I'll probably die first. Those things we own in community property will get a complete step up no matter which of us die. Those things are my separate property, only get a step up if I die. Rental of residence to sale. Many people know that they have $250,000 exclusion per person, 500 together, on selling their primary residence on capital gains. So can I take one of my rentals, move into it for a year or two, sell it, and exclude some gain? Yes. So it's 2 of the last 5 years, pro rata the 2 over the $500,000. So if I only need a $250,000 exclusion between my wife and myself, I would have had to live at one of the last 5 years. Charitable remainder trusts, which we'll talk about in a minute because George is all over that. Partial transfers. Could I transfer part of it to my kids, keep part, get a step up in my side when I die, and not in their part? Sure.
I think so. Yes.
Gift up to step up. When the exclusion amount got so high, let's say, God forbid, I was worried about my mom's health, she was going to die in the next couple of years, like one of my clients, as long as it's going to be more than a year, could I gift my mom the $3 million industrial complex I have, use $3 million of my coupon, she then has it, she puts it in a trust for me and my kids after she dies. Her estate, let's say, was less than that $13 million that was left. When she dies, she then puts it in a trust that's for my benefit for the rest of my life and my kids' life. It gets GST or generations giving provisions. It's asset protected, and wait for it, it got a step up in basis when she died, and then now we can redepreciate it. And if we sell it, there's no capital gains tax. So gift up to step up. Private annuity trusts were just like deferred sales trusts that were good prior to 2006. I would say until 2010, there were still people doing it, even though the IRS said really no. If you have a private annuity trust older than 2006, probably it's wise to have it looked at and kept. If not, it was the old way to do that kind of deferred sale within family members, not anymore. Deferred sales trust we talked about earlier. Equity stripping. If my mom owned that $3 million property, but we needed access to his cash but didn't want to sell it, couldn't we get a loan on the property, keep it in her estate, make the loan payments? When she dies, there's a step up, but we got to the cash early. Sure. Could we do that by buying life insurance with it afterwards so the loan was payable over time and we crushed the value of the loan? Yeah, we could do that too. Hence, you blend strategies. We talked about monetized installment sales and opportunity zones earlier. Now, I realize that this has got to be like drinking water from a fire hose.
Yeah.
Water from a fire hose. But if you think back to the slide that we had just a bit ago, it's not about which thing you do, it's about which things you do in concert. So it's about timing, it's about placement, and it's about combining that gets you to what you need if you're considering the sale of your business with the rest of your planning too.
I just wanted to make a comment on the 10 ways out of highly appreciated property. That sometimes we refer to this as getting off the 1031 exchange train without having to die. And so, what the main point of this slide for the purposes of this presentation, because I know Joe could spend the entire day talking about these different strategies, is for people to realize that it's not just 1031 exchanges that are ways to get out of highly appreciated property. There are other options.
Many options.
And most people don't realize there are other ways to do it and go about it. So,
well, like Shelley says, I teach a course in any one of these, let's say Charitable Trust, for 2 days to financial advisors, attorneys, and accountants. 2 days just on Charitable Trust. So by any means do we cover all in depth enough. But if you're a business owner, your accountant, your attorney, your financial advisor has access to the things that we talked about to talk about how to combine them. And like any good financial plan, because estate planning and tax planning are subsets of financial planning, it's about how you blend.
sweet. So George.
George, you're up. Are you going to be Van and flip the slides for us?
Yeah, I'm gonna control the slides for you, so we don't have to deal with the switch over. And just let me know when you want me to move on. Okay, George.
Great. Thank you, Shelley. I hope everybody can hear me.
Yep.
Great.
Sound good.
Good afternoon. Thanks again for having me. So just as background, I'm George. I'm a Senior Development Officer at the California Community Foundation. We're a 501c3 public charity, and we focus on helping individuals and businesses achieve their charitable goals in LA and surrounding communities. So my role specifically there is to help donors make smart donations, often using complex assets. So hopefully this information will be helpful. In the next few slides, I'll be talking about some asset types for charitable giving, 3 charitable giving vehicles, and then we'll walk through a quick case study to illustrate some of the numbers. So here we go. So if we take a quick look at the different types of assets that could be used, I'd just point out that the most common asset for charitable giving is cash. However, there's a lot of tax benefits to giving complex assets, which are just essentially non-cash appreciated assets. So you see this list of examples here: publicly traded stocks, real estate, interest in any closely held business, including C Corps, S Corps, LLCs, and partnerships or limited partnerships. And then we have art and collectibles. So these make for better donations for the donor, given most of the time these are assets that they acquired for much less than what they're worth currently. And if they were to sell them themselves, that liquidity event would result in a tax liability for them. So by donating these types of assets, they not only reduce or sometimes eliminate tax liabilities, they also get a full fair market value deduction to offset other income. And then ultimately, they generate more money for the charities that they want to give to. So we'll see that how that works with the numbers at the end with the case study. But before I move on from this slide, I just have 3 items that I always like to highlight. The first one, and I mentioned it briefly, is that fair market value deduction. So generally, gifts of non-cash appreciated assets to public charities allow a donor to take a fair market value deduction. Note that that's capped by adjusted gross income limitations, and we'll look at a chart on the next slide afterwards to explain.
You weren't ready. Sorry.
Not ready yet. Yeah. So that's the first one. The second one is the appraisal. So donors who make gifts of non-cash assets valued for more than $5,000 are required to obtain a qualified appraisal done by a qualified appraiser, and then include that with their tax return to substantiate that deduction. The issue here is timing. So generally, a qualified appraisal can be obtained up to 60 days prior to the contribution, or anytime after the contribution, as long as it's before the deduction is claimed on the return. And then the time and marketability. So most organizations that accept non-cash appreciated assets prefer to liquidate the assets sooner rather than later and convert it into philanthropic dollars. So organizations are often analyzing gifts for marketability. For example, complex assets like gifts of restricted stock will require a review of corporate documents, buy-sell agreements, and any other documents that'll impact the donor's ability to transfer those shares. That said, though, most of these assets are case by case, and there are situations that we can hold business interests, for example, for 5 years or sometimes 10 years. So the next slide here is.
One second. Sorry, Joe. Here you go.
Thank you, Shelley. So this slide here just kind of tries to illustrate the amount of the charitable deduction amount and the AGI limitations that apply. So on the left side, you'll see the different asset types. In the middle column, you'll see that these types of assets contributed to a public charity are entitled to receive a fair market value deduction. The one that sticks out here is at the bottom, art and collectibles. So when you're giving art or collectible items to a charity, you have to ask yourself if that entity or that organization has a related use for that type of asset. So for art gifts, think of museums. If they do, you can take a fair market value deduction. If they don't have that related use, you're limited to a cost basis deduction. And then on the far right, you see the AGI limitations for adjusted gross income. Cash gifts get 60%, publicly traded stock and these others get 30% up to AGI. The thing to note here is to the extent that fair market value exceeds 30% of that year's adjusted gross income, the remaining portion of the deduction could be used in the next subsequent 5 years. So on the next slide here, we're talking about charitable gifting vehicles. So aside from giving directly to nonprofit organizations who may or may not be able to accept non-cash appreciated assets, donors could choose one of several charitable giving vehicles. These are the 3 that we just like to highlight. The first is the Donor Advice Fund, or DAFs, which are charitable giving funds maintained at public charity supporting organizations like community foundations. They're essentially charitable checking accounts housed at 501c3 organizations. These can be established by individuals, families, businesses. They take as little as 24 to 48 hours to set up. They don't require any startup fees. However, Many donor advised fund providers require a minimum contribution, something between $5,000 and $25,000, and then they also assess an annual fee of approximately 1%. Contributions of cash and non-cash assets can be made, and they yield a fair market value deduction because they're essentially a part of the public charity. Once the fund has assets, the donor can recommend grants to their donor advised fund from their donor advised fund to support various charities, and then the provider will cut those checks and send them out. And then with donor advised funds, the tax rules don't require any portion of the donor advised fund to be granted out in any given year. So the donor has time and flexibility to create a charitable giving plan, identify organizations they want to give to and support, and then make grants out on their own timeline. Next one.
George, we have a quick question, and I think it's referring to the last slide. Are these AGI limitations also the same for CRT?
So with the CRT, it depends on what I'm going to cover CRTs in a moment, but it depends on the charity that the remainder is going to, for example. If that's a public charity, then these limitations apply.
Okay, thanks.
So the next one on this list, on one slide before, Shelley. So the next one here is private foundations, just a little background. These are charitable organizations that typically require engaging a lawyer to prepare or set up. They're created by that initial contribution the individual makes into the private foundation. Their funds and their programs are managed by their own designated trustees or directors. And then there's two categories of private foundations. So there are private operating foundations and non-operating foundations. The difference is that the operating foundation actually runs the charitable activities that they fund, whereas the non-operating simply disperses funds to other charitable organizations. Gifts to private foundations are subject to more stringent AGI limitations. For example, gifts of cash to private foundations can be used up to 30% of AGI, and then gifts of non-cash assets other than publicly traded stock are limited to cost basis deductions. And then another major distinction between donor advised funds and private foundations is that tax regulations require private non-operating foundations to distribute a minimum of 5% of their assets on an annual basis. Donor advised funds are not subject to that same requirement. And then the third one, charitable trusts. So I like to boil these down into two main types of charitable trusts. There are charitable remainder trusts, or CRTs, and charitable lead trusts, CLTs. Charitable remainder trusts, it's essentially a planned giving vehicle that allows the donor to make a gift of cash or non-cash assets into a trust that then makes distributions to a designated beneficiary for a fixed period of time, say 10 years or 20 years. And then at the conclusion of that period of time, the trust distributes any remaining assets to a charity. So given the donors committing to make a gift at the outset of the trust, they are allowed a deduction for the present value of that remainder portion that is to be donated. Charitable lead trusts, or CLTs, are essentially the inverse of CRTs, with the main difference being that the trust makes distributions to a charity for a fixed period of time, and then at the end of that period of time, the trust makes a final distribution to a designated beneficiary, which could be the donor or another beneficiary. Similarly, they're entitled to take a deduction as well. The two items I'll note for charitable trusts is that in both CRTs and CLTs, the distributions to designated beneficiaries can be set up as either an annuity payment, meaning it's a predetermined amount for each payment at the outset, or it could be a set percentage of return, meaning each payment will vary based on the investment performance of the trust's assets. And then another thing I'll note is that with either one of these, a donor advised fund can be the recipient charity that receives the remainder, either in a CRT or the distributions in a CLT. So for example, a donor can set up a charitable remainder trust, designate themselves to receive annual distributions for 20 years, create a stream of income, and then after 20 years, the trust can make a distribution to the donor advised fund that the donor can use to make grants out to nonprofits they want to support over the timeline. So these are highly flexible, complicated tools. As Joe mentioned, you could talk about these for days. They require a lot of planning and modeling. So if you're interested, feel free to follow up with us. The last slide I have, or the last 2 slides, is just a quick case study. So this is a gift of real estate, and just to illustrate the numbers. In this example, we have a donor who owns real estate, investment real estate for more than a year. Say the fair market value in the property is $2 million and their tax basis is $100,000. And the donor shares that their goals are to reduce overall taxes paid and then make gifts in multiple charities they want to support without using any existing cash. So we'll compare how things turn out if they were to sell the asset themselves and contribute the proceeds to charity or into a donor advice fund that they set up, versus what happens if they were to just deed that property to their donor advice fund. We'll see the latter is beneficial, given it eliminates capital gains tax, increases their deduction, and then they're allowed to give more money out to charity. So on the next slide, we'll just go through 2 quick options. On the left side, we'll see, so the donor sells the property and then gifts proceeds to their donor advice fund. Upon the sale, they'll realize capital gains of $1.9 million, $2 million less the tax basis, and that generates, just based on the 20% capital gains rate for federal tax purposes, that's $380,000. That's not taking into account any other federal or state taxes. Assume they intended to give all of it to charity, they can then donate $1.62 million to their donor advice fund, support various charities from there, and then they're entitled to take a deduction for $1.62. That's subject to AGI limitations. And then compare that to option 2, where all the donor needs to do is deed the property to their donor advice fund and let the donor advice fund provider market and sell the asset. Upon the sale, given the donor advice fund provider is a public charity, there's no tax liability there. The proceeds from the sale, all of the proceeds go into the donor advice fund, so giving the donor the ability to grant out $2 million, which is $380,000 more in this situation. And then the donor is eligible for a full fair market value deduction. So $380,000 more, they can deduct $2 million. So this is very simplified. Donors have the option to give an undivided portion of their assets. So think of the numbers if you were to give 20% of that property, and it's just to illustrate the difference in timing and what you do if you just deed the property to the charity instead.
Very interesting.
The only thing that I'd add in, there was one of the questions that came through on the chat. If you're a business owner and you're considering donating part of your own business to a CRT, charitable maintenance trust, remember that you're limited to basis if the CRT goes to your own foundation. So like George said earlier, if it goes to a public charity after the CRT, not a big deal. But if it goes to your own private foundation, it's limited to your basis for the deduction. It's still not a bad thing to do, but your tax deduction would be less. So it's a common trap to be careful.
Thank you, Joe.
Any more questions, please go ahead and type them in. Here is Joe and George's information. I'm incredibly impressed that you guys finished on time today.
Only because George was kind to me.
I mean, really, I think that might be a first.
For who?
For you.
George, I think Shelley's picking on me, and you're just coming along for the ride on that one.
Well, I would agree with her. That is a first.
Oh my gosh, now my 2 partners.
Sorry.
Tell me. Both of my partners, Melissa and Shelley, are now picking on me.
Yeah.
Well, Kathleen is just dying. And Kathleen would say, you give an Italian attorney a microphone, and what do you expect?
Right?
You betcha.
Yes.
So thank you all very, very much for joining us today. Yes, these are thick subjects. Yes, there's a lot going on our next presentations as well. Fabulous presenters really know what they're talking about. By all means, these programs are not meant to be comprehensive. You've got your own answer. They are meant for sure to make sure that you are expanding your horizons. That if you've heard about one way to take care of things, or one way to get out, or one way to sell, or one way to avoid a tax, that there's a whole spectrum of things that you should be looking at. And your advisor team, your CPA, your attorney, your financial advisor are uniquely positioned to help you figure that out. So Melissa, how did we do today?
I think you guys did great. Thank you very much, Joe. Thank you very much, George. It's great to see you. It's great to have you guys. You guys really know your stuff. If anybody has any questions, you can either reach out to either George or Joe, and they will answer your questions. We are going to have the next one. What's the date, Shelley? It's September 29th?
No, that's today.
No, sorry, October 27th. October 27th, 2:30 to 3:30 is our next session.
Today's.
So if you're interested in participating in that one, we'll have some emails that will start to go out shortly, so that you can see who the panelists will be. But we hope that you can join us back here for that. And if anybody's interested in the chapters, feel free to reach out to Joe, Shelley, or myself, and we can help you get connected with the chapters as well. So thank you very much for participating and joining us here today.
Thank you all.
Thanks,
Have a
Joe.
great day.
Thank you.
George.
Thanks, Kathleen. Bye, Gina.
Thanks, Kathleen.
Thank you.
All right.
A pleasure. Bye, guys.
Thanks, George. Bye, Kathleen.